Alright, welcome back to the channel, everyone. I'm Murph, and as always, I'm here with the man who actually runs the numbers, Cooper.
Hey everyone, good to be here.
Coop, I have a question for you. What is the single dumbest, most backward, absolutely insane investment strategy you can possibly think of for crypto?
That's a long list, Murph. You could leverage trade based on astrological signs. You could ape into any coin showed by a cartoon avatar with laser eyes. Or you could try to time the market using a magic 8-ball.
Okay, all good contenders. But I think I've got one that tops them all. What if we intentionally, every single day, for a full month, bought the single worst performing coin on the market?
Pauses. You mean, we open up CoinGecko or CoinMarketCap, sort by top losers in the last 24 hours, and just buy number one?
Exactly. We buy the biggest loser. The coin that's bleeding the most. The one everyone is panic selling. We run towards the fire, not away from it. We did the math, we ran the simulation, and today we're going to break down what happens when you buy the worst coin every day for a month.
And this is probably the most important time to say it, so I'll say it loud and clear for everyone. This is a thought experiment. It is not, and I repeat, not financial advice. Do not try this at home. We are exploring a hypothetical to learn about market mechanics. Seriously, this is for educational and entertainment purposes only. The strategy is, on its face, terrible.
He's not kidding. We're professional idiots, don't be an amateur one. So, let's set the stage. What were the rules of this insane experiment, Coop?
The rules were simple and strict. We started on April 1st, 2024 and ran it for the full 30 days of April. Every day at midnight UTC, we would look at the list of the top 150 cryptocurrencies by market cap. We'd identify the one with the largest percentage loss over the previous 24 hours. And then, we would hypothetically invest exactly $10 into that coin.
$10 a day. So, a $300 total investment over the month. Small, simple, easy to track. Why the top 150, by the way? Why not the top 500 or the whole market?
Liquidity and relevance. If we go too far down the list, we'd be buying obscure, untradeable microcaps that might be down 90% because only 3 people trade them. Sticking to the top 150 ensures these are generally established, or at least significant, projects that are having a genuinely bad day for a real reason, not just because of low volume.
Got it. So we're buying real projects just on their absolute worst days. I'm so excited and terrified to see this. Let's dive in. How did we start the month? What was our first purchase on April 1st?
Well, April started right in the middle of a very volatile period for new token launches. So our first few days were dominated by that. On April 1st, the biggest loser was Wormhole, the token symbol is W. It was down about 18% on the day.
Oof. Wormhole, the big cross-chain bridge protocol. That was a huge airdrop and launch. I remember the hype was massive, so buying it on a big down day feels classic. We're buying the post-hype slump.
Precisely. That's the theme you'll see. A lot of these biggest losers are assets coming down from a major peak, whether it's a launch, a narrative pump, or a news event. So, day 1, we put $10 into Wormhole. Day 2, April 2nd, another new hype-up project took the top loser spot, Ethereum token ENA. Down about 15%.
The synthetic dollar protocol. Again, massive hype, huge airdrop. So in 2 days, we've invested $20 and we own 2 of the busiest new projects on the market, but we bought them while they were getting hammered. How did that first week play out?
It was a fascinating mix. After those 2, our day 3 purchase was Waves, the layer-minus one blockchain, which was down around 12%. An older, more established coin. Then on day 4, the market turned on meme coins, and the biggest loser was Dog with
The dog with the hat. Of course. WIF had an absolutely god-tier run up to multi-billion-dollar market cap. It had to cool off eventually. We basically bought the top of the local meme coin fever.
We essentially provided the exit liquidity for someone who bought it a month earlier. We paid $10 for WIF while it was down 20% on the day. The next day was a big one. The entire market took a dip, and the project that led the charge downwards in the top 150 was Solana.
No way. We bought SOL? But that's a blue chip. Or a purple chip, whatever they call the top alts now.
Yep. On April 5th, Solana was the biggest loser in that bracket, down about 10%. This was during the height of its network congestion issues. Bots were spamming the network, transactions were failing, and the narrative soured for a day. So we bought the dip on a top-tier asset.
Okay, so just to recap week 1. We have Wormhole, Ethereum, Waves, Dog with Hat, and Solana. That is a chaotic portfolio. A new bridge, a new synthetic dollar, an old layer 1, a dog meme, and a top 5 project. What a mess.
It's the definition of de-worsfication, as some call it. The week rounded out with XE Infinity X on day 6, as the GameFi narrative continued to cool, and Phantom FTM on day 7, another layer 1 that just had a no news, bad day in a sideways market. So at the end of week 1, we've invested $70.
And what was that $70 worth? Let's get a quick check-in.
At the end of the first week, our $70 portfolio was worth approximately $62. Some of the coins we bought, like Ethereum, continued to slide a bit after our purchase. Others, like Solana, had a small bounce. But overall, we were down about 11%. Not a total catastrophe, but definitely not good.
Down 11%. I mean, for buying the absolute worst coin every day, I was expecting to be down like 40%. This is the core of the experiment, right? The battle between two forces, don't catch a falling knife versus be greedy when others are fearful. Exactly.
Falling knife suggests it will just keep falling. But the buy the dip mantra suggests that a sharp drop is an overreaction and presents a buying opportunity. This strategy is the ultimate test of which of those adages holds more truth in the short term.
Alright, let's get into week 2. Did the portfolio get any less chaotic?
I wouldn't say that. Week 2 saw us buying into a lot of the Solana ecosystem infrastructure and some of the newer tech plays that were correcting hard after a strong turn. We started the week buying Jupiter, the token GUP, a major aggregator on Solana.
Makes sense. If Solana has a bad week, the projects built on it will likely have a worse one. It's a beta play.
Correct. The next day, we bought Pyth Network, Pyth, the Oracle solution. Then Starknet, STRK, the Ethereum Layer 2, which has been in a steady downtrend since its launch. Then Ron, the gaming blockchain, which gave back some of its big gains. It was a week of infrastructure and ecosystem plays cooling off.
So we're not just buying Flash and the pan meme coins. These are serious, venture-backed projects with real technology. They were just the market's least favourite thing on that particular day.
Precisely. The second half of the week got even more interesting. We bought Helium Mobile, Token Mobile, after its massive run. We bought WorldCoin, WLD, Sam Altman's iScanning crypto project, as regulatory concerns were swirling. And we finished a week buying say, another fast layer 1 that was just getting hit hard in a market-wide drawdown.
Man, WorldCoin. That's a controversial one. So we're not only buying financially volatile assets, we're buying narratively volatile ones too. Okay, end of week 2. We've now invested $140. How's our beautiful, terrible portfolio looking?
By the end of week 2, our $140 investment was worth about $115. We were now down around 18%.
Ouch. The losses are accelerating. So the falling knives are, in fact, continuing to fall.
In many cases, yes. What we're seeing is that if a coin is the biggest loser on a Monday, there's a pretty good chance it's still going to be in the red on Tuesday and Wednesday. There's momentum to the downside. A single bad day is often part of a multi-day bad trend. Buying the first big red candle is rarely the bottom.
That's a huge insight. The market doesn't just overreact for 24 hours and then instantly correct. The sentiment that causes a 15% drop often takes several days to wash out. So our strategy is basically guaranteeing we buy too early.
Almost every single time. We are buying on day 1 of a 3-day bleed out, for example. We're catching the knife by the blade, not the handle.
Alright, this is getting painful. Let's rip the band-aid off. Week 3. This was mid-April, and I remember the market took a nosedive. This must have been a bloodbath for our strategy.
It was. This is when global macro fears, talk of delayed rate cuts, and escalating geopolitical tensions really hit the market. Everything went down, but as always, some things went down more than others. And our strategy forces us to buy the things going down the hardest.
So what did we add to our chamber of horrors?
We started week 3 buying Bitcoin Cash, BCH. It had just had its halving event, and this was a classic sell the news reaction. It had a huge run up into the event, and then dumped. We bought that dump, a drop of about 20%.
The classic post-halving sell-off. We bought it. Of course we did. What's next?
The next day we bought Stacks SCX, the Bitcoin Layer 2. The narrative was shifting away from Bitcoin ecosystem plays, and it got hit hard. Then we bought the Graph, GRT, the indexing protocol. Then of one of the original blue chip DeFi lending platforms.
Whoa, off. That's like a crypto institution. Why was it the biggest loser?
The whole DeFi sector was getting hammered with fears of regulation, and a general rotation out of the space. Which leads to our next purchase, which was perhaps the most significant of the month. On April 19th, the biggest loser was Uniswap, Uni.
Oh, right. That was the day the news about the Wells notice from the SEC came out. The regulators were signaling a potential lawsuit. The market panics.
and we were contractually obligated by the rules of our experiment to buy into that panic. You and I dropped over 15% on the news, and we added $10 worth to our portfolio. It's a perfect example of what the strategy does. It forces you to buy on the day of the absolute worst possible news.
This is what separates the spreadsheet from reality. Clicking buy on you and I that day, even with just $10, would feel awful. Your brain is screaming, this is going to zero. The government is shutting it down.
And that's the psychological barrier. We rounded out that brutal week by buying Near Protocol, another major layer 1, and then Aptos apt. The Aptos purchase was a textbook case of buying a token unlock.
Explain that for the listeners. What's a token unlock?
Many projects reserve a large portion of their tokens for early investors in the core team. These tokens are locked and can't be sold for a period of time. An unlock is a scheduled date when a large chunk of these tokens become sellable. The market often anticipates that these insiders will sell, so the price drops leading into and on the day of the unlock. Aptos had a massive unlock, and we bought it on the day of maximum selling pressure.
So we're buying into post-hype dumps, regulatory panic, and pre-scheduled selling events. This strategy is a masterclass in finding the worst possible entry points. I'm almost afraid to ask end of week 3. We're $210 in. What's the damage?
At the end of week 3, our $210 investment was now worth approximately $155. We were down over 26%.
Oof. Down 26%. That's a proper bear market beating. It feels like this is just a slow road to zero. Is there any hope at all? Did anything we buy actually go up?
Yes, and this is where it gets interesting. While the overall portfolio value was sinking, a few of our early purchases were starting to show signs of life. Remember day 1 when we bought Wormhole? By the end of week 3, that $10 purchase was actually worth about $12. It had found a bottom and bounced a bit. Solana was also back to around our entry price.
A green shoot. A tiny, little green shoot in a sea of red.
It's the principle of mean reversion. Assets that experience extreme price movements in one direction often tend to revert back towards their average price over time. Some of these drops were genuine overreactions. The problem is, for everyone that bounces back, 2 or 3 others with the start of a much deeper, more prolonged downtrend. We bought Starknet in week 2, for example, and it just kept bleeding. Our $10 in SDRK was worth about $7 by this point.
So it's a minefield. You might step on one that bounces you up, but you're more likely to step on one that explodes.
A very good analogy. The portfolio is a mix of oversold bounces and falling knives. The problem is the knives are sharper and more numerous.
Okay, we're in the home stretch. Week 4. Let's bring it home. We've got $90 left to spend. What other horrible decisions did our strategy force us to make?
Week 4 had one of the most educational buys of the entire month. We bought Hedera HBAR.
Oh, I remember this. This was wild. There was a news story that BlackRock, the world's largest asset manager, was tokenizing one of their funds on the Hedera network. The price of HBAR exploded. It almost doubled in a few hours.
It did, but the news was quickly clarified. It wasn't BlackRock choosing Hedera, it was another company, Archax, that built on Hedera, who tokenized their shares in a BlackRock fund. The market had misinterpreted the relationship. The initial pump was based on a misunderstanding.
So the price came crashing back down just as fast.
And you know who was there to buy it after it had round-tripped?
We were. Our strategy made us buy the dump after the misinformation pump. That is just poetic.
It was the biggest loser on the day, down over 25% from its peak. It's a perfect lesson in buy the rumor, sell the news, except we were forced to buy asterisk after asterisk. The news was proven to be mostly rumor.
Unbelievable. What else did we get in that final week?
We continued to pick up high-quality projects that were just out of favor. We bought Pendle, the yield trading protocol, after its insane run. We bought Celestia Tia, the modular blockchain, as its narrative cooled. We added Render, our NDR, the decentralized GPU rendering project, and Immutable, Inc., a top gaming and NFT platform. All of them just had bad days in a choppy market.
2 more solid, well-regarded projects. It's funny, for a strategy focused on buying the worst, the portfolio is actually full of some of the most respected names in the space. We just own them at terrible prices.
Or what asterisk seemed asterisk-like terrible prices at the time. We finished the month buying Lido DAO, LDO, as liquid staking came under pressure, and on the very last day, April 30th, we bought Toncoin Ton.
The Telegram coin. That thing had been on an absolute tear. It went from outside the top 20 to inside the top 10. We must have bought the very peak of that cycle.
We bought its first major red day after that massive run-up. It was down about 9%, which was enough to make it the biggest loser in the top 150 on an otherwise quiet day. So that was it. 30 days, 30 different coins, $300 invested.
The moment of truth. My stomach is in knots. The big reveal. After all that pain, after buying every dip, every panic, every sell-off, what was our final portfolio value on April 30th?
Pauses for dramatic effect. The total amount invested, as we said, was $300. The final value of our 30-coin portfolio at the end of the day on April 30th was $248.
Wait, what? $248? We were only down $52.
Correct. A total loss of about 3%.
I am genuinely shocked. I was expecting a catastrophic, -$150 number. After being down 26% in week 3, I thought we were heading for 40% or 50% loss. How did we recover from that week 3 low?
A few things happened. First, the market as a whole found a bit of a footing in that last week. The panic from mid-April subsided, so the general tide stopped going out so aggressively. Second, and this is the key takeaway, the power of dollar cost averaging, even in this bizarre form, is significant.
Explain that. How does DCA help when you're buying garbage?
Because we kept buying. When our portfolio was at its lowest point, down 26% after week 3, we didn't stop. We deployed another $70 in that final week. We were buying assets at what turned out to be the period of maximum pessimism for the month. Those later purchases had less time to go down, and the market's small recovery meant they were closer to break even or even slightly in profit by month end. It cushioned the blow from the earlier purchases that were still deep in the red.
So continuing to buy, even when things looked bleakest, actually saved us from a much worse outcome. That's counterintuitive. Let's break down the portfolio itself. What was our single best performing purchase? Which of these losers turned out to be a winner?
The best performer was one of our most controversial buys. Our $10 investment in Uniswap, which we bought on the day of the SEC Wells notice.
No way. We bought the absolute peak panic.
And that turned out to be the exact bottom for the month. The market realized the legal process would be long, that the protocol itself was still functioning perfectly, and a lot of the fear was an overreaction. That $10 we spent buying you and I in a panic was worth about $14. $50 by the end of the month. A 45% gain.
That's to be greedy when others are fearful mantra in its purest form. We were forced to be greedy and it paid off. What was the worst performer? The biggest falling knife that we caught?
That unfortunate honor goes to StartNet SDRK. It was in a steady, brutal downtrend, and our purchase was just a blip on its way down. Our $10 investment in SDRK was worth only about $5. $20 at the end of the month, a loss of 48%.
Oof. So a 45% gain on the best and a 48% loss on the worst. It's a huge range. What does the distribution look like? Were most coins up or down?
Out of the 30 coins we bought, only about 6 were in profit by the end of the month. So 24 of them were losers. The vast majority of our picks were, in fact, bad buys in the short term. The few winners, like Uniswap and Wormhole, just happened to bounce hard enough to partially offset the sea of red from everything else.
So the strategy is still overwhelmingly a losing one. 80% of the time, we bought a coin that just kept going down.
Correct. Which confirms that trying to catch the absolute bottom is a fool's errand. You will fail most of the time. The knife will cut you.
So let's get to the big conclusions. After this insane experiment, what are the major takeaways for the average investor?
I think there are 4 key lessons here. First, as we just discussed, is that the dip is not as simple as it sounds. A dip is often the beginning of a larger slide. Blindly buying a big red candle is a high-risk, low-probability strategy. You need more than just a price drop as a signal, you need a fundamental reason to believe it's undervalued.
Okay, lesson 1. Don't just buy something because it's done a lot. It can, and likely will, go down more. What's lesson 2?
Lesson 2 is about the nature of these losses. We weren't buying random rug pulls. We were buying Solana, Uniswap, of Aptos, Celestia. These are fundamentally significant projects. The reason they become the biggest loser on any given day is often due to short-term factors, network issues, regulatory fears, token unlocks, narrative shifts. This strategy forces you to accumulate high beta, high volatility versions of the market's current narrative.
So when the market is worried about regulation, you buy the coin with the biggest regulatory target on its back. When the market is selling off after a meme coin pump, you buy the meme coin.
Exactly. It makes your portfolio a lightning rod for whatever the market is currently afraid of. This is generally a terrible way to manage risk. However, it did give us a weirdly diversified portfolio across layer 1s, DeFi, infrastructure, and memes. This diversification, as accidental as it was, is probably why we didn't go to zero. One sector's catastrophe was cushioned by another's mediocre performance.
That's the diversification we talked about. A portfolio of 30 different losers is less risky than going all in on one loser. Got it. What's takeaway number 3?
The psychological difficulty. Murph, you said it yourself. Imagine having to log in every single day, look at the asset that everyone else is desperately selling, that news headlines are calling doomed, and forcing yourself to click buy. It's an unnatural and painful act. Most investors would break. They'd skip a day, they'd see the biggest loser as a coin they hate and say not that one, and they break the model. The discipline required to execute a truly contrarian strategy like this is immense, even if the strategy itself is flawed.
I couldn't do it. My emotions would get the best of me. I'd see the portfolio down 26% and I would just stop. I wouldn't have made it to the final week where things recovered slightly. The emotional toll would be too high. That's a fantastic point. And the final lesson?
Dollar cost averaging is magic. It's the only reason this wasn't a total disaster. By consistently investing the same small amount, $10, we bought more tokens when the price was low and fewer when it was high. Even within this awful strategy, DCA was a great mitigator. It smoothed out our terrible entry points. It forced us to keep buying when the market was at its lowest, which is when the best opportunities were, as shown by the Uniswap trade. A 17% loss is bad, but is shockingly resilient for a strategy designed to fail. It shows that *** you invest in this case, with consistent discipline, small amounts can sometimes be as important as *what you invest in.
Well, so to sum it all up, the strategy is bad, don't do it. Buying the biggest loser means you're almost always buying too early. You end up with a portfolio of narratively damaged goods, and it's psychologically brutal. But if you do it with a diversified approach across many assets and with strict dollar cost averaging, the result is less catastrophic than you'd think.
That is the perfect summary. It's a failed experiment, but a deeply educational one. It reveals the underlying forces of mean reversion, the psychology of panic, and the mathematical power of consistent investing.
I learned a ton, and I hope all of you did too. A huge reminder, once again, this was not financial advice. This was a simulated experiment to learn about the market. Do not go out and start buying the biggest losers.
Please don't. Your portfolio will thank you.
Alright, that's all the time we have for today. Let us know in the comments what you thought of these results. Were you as shocked as I was? And what other crazy experiments should we run next? Don't forget to like and subscribe, and we'll see you in the next one.